Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So it's the Friday before Thanksgiving, and while we have, I think I've hosted now about a little over 1,000 of these, all but maybe 4. We will be taking next week off, so we have more than enough content to keep you busy if you've missed the last 2 weeks. That I think pretty much carries through for what will be a quiet week. We just wanted to thank you again for your support. You know, we started this with just grassroots, so we're up to almost 2,500 subscribers, you know, very consistent viewers, and it's because of you. So thank you. This is what we are thankful for as we head into Thanksgiving. So before we get into it, you know, have a great weekend, you know, happy Thanksgiving, and hopefully you get to spend some time with family. So with that being said, we get to jump into our primary vision frac spread count. And then from there, we're going to look at a quick update on crude demand now that we have some lockdowns coming through. And we'll go through what does that mean, how are things changing, and then a quick update on some food and inflationary data that has come out recently. So one of the things that we want to look at is the frac spread count. So we're up by 1. We went from 269 to 270. I don't think it's any real surprise. Again, our target has been 275, so we do think that there will be a little bit more activity into the next week. But this is normally when we start to see that kind of peak, and then we'll start to roll over. So this could be the top. We could have missed it by 5, which was our call from back in March for those that were have been with us this long. So this will be something to pay attention to. So there was some reduction in activity in Appalachia. There was some reduction in in the Western Gulf, but a lot of that is just moving assets around. But one of the things that for the clients that have gotten our insights, you know, we finally got those last remaining Permian crews getting activated, which is what we were expecting. You know, we were saying it was 3 to 5. You know, we came in right in the middle. So again, we saw that nice little increase, which again just kind of shows that we're going to finish out fairly strong and then look to break out again in 2022 with some additional equipment. But the problem is that, I mean, anybody knows this at this point, but it's steel availability, pipe availability, labor availability. So these are going to be some key issues that we've been talking about forever, or it feels like forever, and then it'll continue to be an issue, but the question's going to be by how much as we go into 2022. Then when we look at drilling, so when we look on the rig side, we had oil rigs increase by 7. They were all horizontal. So again, we got another increase. Horizontal rigs are back over 500. The U.S. is now at 563 in total. And one of the things that we've been talking about for months now is that scoop and stack, saying that, look, the liquids basket, the NGL basket is getting much better. And because of that, there's a little bit of sustainability that we haven't had previously based on where exports are. We've talked about some issues that could arise as we go into Q1 of next year, given the congestion in the Panama Canal, as the Panama Canal Agency or the authority has put more of an emphasis on container ships and LNG, putting some issues on the LPG side, which could slow some of these issues, but again, not stop them in terms of where the exports are. Ethane continues to be robust, as we covered in the EIA show. So again, that's bringing in a lot of this different capacity. Now, when we look at where drilling is, we think drilling does continue, as we were saying, rigs continue to go up as we get some of this flatlining on the rig side, on the frac spread side, which is something that we think continues really into year end and then into Q1 of 2022. Now, when we provide just a brief update on some of the issues on the mobility side, so far mobility has been strong in the U.S. We do think that continues into obviously next week. It's just a question of, is some of it pulled forward? Because if you can work from home, would you rather spend time with family? Maybe there are people going a little bit earlier. So it'll be interesting to look how Monday and Tuesday looks, and obviously Wednesday of next week, to see where we sit and how that's going to close out. But we do expect to be a fairly normal. We're closer to what what AAA was saying, of only a 5% decline from 2019. We're between that 5-10%, which I think is a fairly stable view. Now, when we look at some of the data sets, China remains slow. That is something that is going to continue given their still spread of COVID in the region. But on the bigger side, when we look at Europe, Europe is starting to slow down again. Austria has rolled out a full-on nationwide lockdown. Germany has talked about it, but then they said, look, we're not going to do a full lockdown, which is something that we said in the EIA show. We don't expect full lockdowns. We expect regional issues, regional lockdowns, some restrictions. But again, lockdowns, we're past that point. And I don't think we're going to get back to that level. But these issues and these problems are just going to keep consumers on the sidelines. Like maybe instead of going to the store twice, I'll go once. I'll skip this one. So that's where we see some of that just paring back. But we're not going to get those huge drops that we saw in 2020. We're past that point. It's more along the lines of, is it going to be a 500,000 barrel a day issue, a million barrel a day issue? We're not going to see 20 million barrels a day coming out of demand. So again, those are some of those little pieces. When we look at what's happening in China right now, so you can see there was a small bounce in storage at the teapot side. We expect it to kind of stay at this level. We do have more cargoes heading into China. Some of the containers, I should say, the VLCCs are at a 4-month high in terms of what is flagging China as their direction. And again, this is what we were saying, where we started to see drawdown of the offshore storage, and that is again going to be replaced with what is in transit, which is why we were making such a big deal in the EIA show in segment 3 about crude in transit, crude on the water, because we're seeing an increase not only just in storage, but also what's in motion, and then that'll just go from one spot to another. So this is something where we're starting to get some of this balancing act. The problem is there's some renewed issues on the tax side with what China is doing with the refiners, but we'll talk about that in a minute. The slowdown in general with what Shandong has done, what the state-owned refiners have done, we're just not seeing a lot of buying from China. And again, they're taking their term contracts, but they're not taking spot. So that's when you start looking at Nigeria. And I know I talk about West Africa a lot, and it's because they're the first to announce their loading schedule. They're the best premium, if you will, in terms of quality, and then Urals is the last. So you kind of get this bell end of where is that demand. So what we have right now, Nigeria still has 15 to 20 cargoes unsold for December. That's at a slower pace than normal, given January trading is already starting. Again, it's slower than it was. It's not as bad as it was in November, with November, when 25 million barrels of crude was unsold, mostly for November loading, which was in October for November. There's still some available, but Angola, 4 to 7 unsold December shipments, a somewhat slower pace of sales, versus drops from 7 to 8 unsold cargoes for November. But we still have 3 to 5 in November. So they're still unsold in December and still unsold in November. And then 1 to 3 consignments unsold for December added for Congo, which drops from the 3 to 4 unsold for November. So a little bit of an increase. But if you remember last year, China typically has a big buying spree that happens in November, and then they really slow down in December because it's transit time. They want to make sure that the crude is there for the renewed import quotas, for the new quotas in general. So you have big buying in November, then you have the transit time, and then you start to show up in January and February. And we're just not seeing those movements. We've seen an increase. I'm not saying we haven't. We're at a 4-month high, but it's not where we should be on a seasonal basis, which again just shows that that lackluster move into China remains. Then when we look at fuel oil storage dipped down a little bit, but we just wanted to highlight, so private oil refiners in China's province have been ordered by the government to run self-assessments and probes into their tax compliance dating back to 2019. Companies and local authorities are to make amendments. Shandong, so 12 billion yuan worth of illegal tax activities and 478 million yuan of fake invoices have been uncovered to date. So these investigations are continuing to erode in refining margins for teapots, and again are pushing them to make some additional run cuts, which is what they want to do. So when you think about what China does, and they've done this in the past, they issue some of these problems and they force run cuts in Shandong in order to incentivize other increases on the state-owned enterprise side. And this was very, I think, well telegraphed when we saw they didn't increase import quotas, but yet there's more refiners coming online in 2022. So essentially, this is going to try to force the least efficient, the dirtiest ones to go out of business and allow some movement without adjusting how much crude is actually being imported. Then when we look at, because we're not going to be doing the EIA show, we'll talk about this here. Here you can see Singapore had that increase in storage that we were talking about on Wednesday. It was an increase of 1 million. So we were expecting a bounce in middle distillate and light distillate. Instead, we did get the big bounce in light distillate, but middle disti is still in a fairly bullish trajectory. We do have some increases, but again, this is the more bullish side when we start looking at the middle distillate. Then when we look at Europe had small builds across the board, more importantly in gas oil and gasoline, which are the two that we're looking at, and fuel oil. But when we look at the Middle East, there's actually a huge flow of new product going from the Middle East into Europe. It's currently en route. It should be here over the next 6 weeks. It's mostly gas oil, middle distillate. And then when you look at Russia, Russia's actually sending a lot of diesel into the Atlantic Basin, which is slated right now, shockingly I know, for Pad 1. So we do have more product coming into Pad 1. The ARB still remains closed between Europe and the US. So again, a lot of this product is just going to be coming from the Middle East. And then the question will be, when does that fuel oil leave Europe and head into Asia, which that ARB is still open, closing slightly, getting a little bit tighter, but still available. And then when we look at lockdowns and some of the restrictions that are being rolled out, we expect to see some additional builds, more importantly, in not only just gasoline, but also gas oil. Now on the inflation front, when we look at some of the rising prices, here you can see that the fertilizer prices in North America hit a new high. And then when we look at pricing coming through India's went up 60%. So again, all of these input costs, we talk about this in our insights this week, as well as in the economy show and the special report that came out yesterday. Then when we look at grocery stores, all sections of grocery stores are seeing rising food prices. The National Grocers Association president said, or Gregory Ferrara says on Bloomberg, when costs are rising across the supply chain for food, grocers can't absorb everything. Much of food inflation is being driven by labor shortages, especially a shortage of truck drivers, which is not going away. And then when you look at fertilizer prices, when you look at seed prices, when you look at grains in general, we're going to continue to see that move up. Now, one of the interesting things, when we can get academic on what is driving inflation, there's always that push by Milton Friedman talking about how it's an anomaly of fiat currency when you start looking at monetary policy and liquidity. But for those that are in the real world, working with this day in, day out, when you have your input prices, so say you have 10 input prices, and each one is going up 3 to 5% month over month, you have no choice but to try to pass that price on. Given some price increases are easy, some aren't, which is why in the econ show, we specifically went through sticky inflation and flexible inflation, because when you look at those numbers, sticky inflation or sticky CPI is much harder, because there are some companies where it's expensive to raise prices. So you have to be very confident that you're going to see this continuation, because you could lose demand. You have to switch around different signage. You have to switch away the way contracts are structured. So again, there's a lot that goes into it. But the flexible side, how the longevity of this, the continuous price increases, as we said last on this econ show previous. Wholesale prices are going up. PPI prices are going up. So again, all of those costs, as we keep talking about prices paid, prices received, there is a lag, and there's not a perfect transition from one to the other, but they're all supportive of just a continuous move higher. And the reason why we talk about that and these are two slides pulled from the Econ show yesterday. When you look at just the share of total spending on food, gasoline, and utilities by income quartile, the first quintile, the lower income households spend a larger share on food and energy, almost 28%. Again, that's why we're so concerned about where some of this movement happens. And then food spending and share of income. So when you look, about $4,000 are spent at the lowest quintile, but when you look at what that is, that's almost 25% of their income being spent on food, which you can see is going higher, which is why the issues of food prices is the lowest earning cohort of U.S. spending. Spends on an average $4,000 on food per year, representing 27% of income. And conversely, highest earning cohort spends $12,000 on food, but is only 7% of income. So as income actually drops at the highest level, as we've seen with wages coming down, not keeping up with inflation, though the lowest level has, a lot of that, if not all of that, is going into food, which is why we talk so much about where these additional dollars are being spent. Then when we look at the sticker shock, consumers are worried about meat, produce, and dairy prices. So when you look at very or somewhat concerned, you can see that over 50% are concerned in meat, produce, dairy, pantry items, beverages, pretty much across the board. We're seeing it. It's being experienced. And based on what the CEO of the Grocers Association said, we're not crazy to think it's there, because it is. Now, just talking about India, just rounding that out, contract pricing for the new potash went up 59% to $445 per metric ton. In Northwest Europe, potash prices rose 1.7%, the most since 2015. And in the U.S., North American fertilizer prices climbed to the highest price ever for a third week in a row. Now, when we start looking at some of the issues on why U.S. trucking rates, again, rose 36.2% in October, most in 3 decades of data, not going away. It's not that it's just the pace is going to slow going up. But again, this is when we start seeing this pivot. And again, these are long-term pivots. So this is when we talk about a pivot, we're looking into Q2, Q3, Q4 of next year, where you have that inflation, again, give way into stagflation as the pace starts to really level off. Then when we look at air cargoes, again, that's remaining elevated. And as commercial flights drop, this is going to, because if you think about 40%, I believe it's 40%. I think it's 40% of cargoes on commercial flights are actually air cargo freight. So as those commercial flights still remain depressed and have gotten more depressed given the COVID issues in Asia, specifically China, that has then, again, cutting that increases the amount that is going onto air cargo flights, which is increasing the price as more competition to get on those levels. Then when you look at global shipping, so as we continue to see shipping issues, freight issues can remain, prices have started to come down, but this is looking at where they are right now. And if this continues going forward, developing nations bear that brunt, as we've been talking about, which is why we have raising rates, even though Turkey cut rates and inflation continues to take off. And their lira goes, I think it's a record now against the dollar, or near record, because I think the record was actually in 2008. But if global shipping costs remain high for next year, global consumer prices may rise by another 1.5% per the simulations by the UN. Supply disruption-induced inflation would hurt developing nations the most, with islands facing a 7.5% increase. Again, these are some of those key issues, the key areas that we continue to see with the additional price. And even if it continues to come down, which I think it will over the next few months, you're going to get an idea of just as those prices come down, the stuff on the ships are going up, which again is just going to keep some of this inflationary pressures alive and well. Now, when we look at some of the leading indicators, so the Kansas City Fed Manufacturing Index fell to 24 versus 28 and is down from 31 in the prior month. A little bit of a slippage, but you can see it's still at a very high level, still expansionary. Starting to see some of this normalizing, as we said in the Econ show, U.S. Empire, New York Empire, very strong. Some of them are coming in pretty strong. New orders dipped into negative territory. That is the leading indicator that is concerning us the most, because you're seeing that more and more. But there's also a lot of backlog. So they're waiting for the backlog before they put in new orders, because would you want to lock in new orders at these prices? And the answer is no. So let some of that backlog clear, see how you can manage some of that at inventory. And in the insights this week, again, we went into detail on why inventories matter for pricing and for where some of this is going to go over time. But then when you look at production, shipments, average work week, and employment, they all fell, but still remain in that expansionary territory. So still in a stronger spot. And despite downticks in November, inventory components of New York and Philly Fed manufacturing index remain in expansionary territory. Again, some of that diffusion, what we've been talking about on where inventories are and how those flows are going to continue. Then when we look at the business outlook, so this is looking at Philly Fed. So a strong November. So Philly was expected to be at 24, came in at 39. Last month was at 23.8. So now this is a little bit different. New orders, prices paid, prices received, shipments, unfilled orders, delivery times, average work week were all up. So, but as we've been saying, prices paid, prices received, shipments of unfilled orders. Again, that's a positive, but delivery times. So you're seeing some of this mixing, which is why the outlook is coming down slightly, but still a strong number, still an expansion, which again is the positive that we like to see. Then when we look at the difference between CPI, urban consumers, and unit of labor cost, you can see this normalize a bit. This is what we should see continue to come back down. It's just going to be a matter of where is inflation and what does that labor cost look like. When there was just a filing that came out saying that people expect really a minimum of a 3% to 5% bump in salary. And I think that's really to keep pace with obviously inflation. But this is going to be something that we're going to continue to kind of dig in on as we go through the remainder of the year. Then when we look at world trade, we said that had that big recovery in trade volumes, which again, we had a lot of inventory was drawn down. Then you had to refill that inventory, but you had that pent up demand that has come through. And that has, again, been supportive, which has kept a lot of these shipping prices elevated. And now another exciting inflationary pressure point when we look at German prices. So when we look at Germany producer price index, so when we look at the PPI, you can see that month over month, it came in at 3.8%. And then year over year, it came in at 18.4%. And I wanted to have a little fun with it and look at what it looked like going back into the 70s. And you can see that it is at a record. So it is at a record. It blew through all record levels going back to the 60s. So it's just something to watch. I'm just going to pull up now. So for PPI month over month, the estimate was for 1.9%. Came in at 3.8%. Year over year was expected at 16.2%. Came in at 18.4%. So this was the acceleration that we saw in October. We've talked about it endlessly on the Econ Show in terms of what I should say through October, how we were seeing that acceleration, and a lot of that has continued into November. The pace will slow. The direction is not going to. We're going to see another month over month increase. And we don't expect that to change at all, especially with renewed lockdowns, renewed issues. This is supply chain problems, keeping, again, that pressure in the system. So we always enjoy the feedback. You can always find me in the direct messages. Your direct messages have been fantastic. I've loved getting to know all of you. So again, another thing that I am thankful for. So we hope you have a great weekend, a happy and enjoyable Thanksgiving. And again, thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.